Hello, today is January 12th, 2023. Happy New Year, and it's time for some new stock picks. As always, I'm going to review the performance of my stock picks from this time last year, do a little bit of a market analysis, give you some new stock picks and the rationales behind them. So this time last year I picked Manulife, the Canadian insurance company. The stock was down 2.1% in US dollars, including dividends. I also picked Service First Bank shares. That was down 22.2%. And I also picked Fabrinet, which was up 12.6%. for an average of minus 2.2% in US dollars, including dividends, which compares very favorably with the performance of the MSCI World Index, as represented by the URTH ETF, which was down 13.1%. This year, most economists are projecting a slowdown in economic activity, possibly a recession. So typically, in this kind of economic scenario, investors tend to hide in more conservative stocks like utilities, healthcare, and tend to underweight economically sensitive stocks like semiconductors, and resource stocks and things of that nature. However, because this recession has been so well predicted for easily the last 9 months or so, the market has already priced in a fair bit of that economic sensitivity and economic slowdown. So perhaps it's a good idea to own some of these economically sensitive stocks, as there's a good chance that if that's the case, that they will outperform the more stable stocks, like the utilities, which have done better in healthcare in the last 12 months or so. With that in mind, my first stock pick is a semiconductor company, Skyworks Solutions, symbol SWKS. Semiconductors for wireless headsets and other devices. The stock is very, very nicely profitable, with a return on equity of around 20%, a little bit more, a little bit less, depending on the year, which is a very, very nicely profitable company. And typically companies with that kind of return on equity trade at the price to book ratio of 4, maybe as much as 5 times, and the stock only trades at 2.9 times or 3 times, around there. So it looks like it's a good price to enter into what's a very high quality business. And of course, if the revenue declines and the stock doesn't do well this year, as long as they maintain the long-term strength and profitability potential, that would be a good stock to own for the longer term. Stock pick number 1. Stock pick number 2 is Freeport-McMoRan, symbol FCX. They're the largest copper producer in the world, and they also have some gold and other minerals and molybdenum. So why a copper stock in a weak economic environment? The main reason would be the transition to clean energy and electrification of vehicles. For example, according to the International Energy Agency, offshore wind power plants require 13 times the mineral resources than a similarly gas power plant. Also, the average electric car requires approximately 53 kilograms of copper compared to only 22 kilograms of a gas car. So even with an economic slowdown and lower demand for new vehicles and so on, the process of moving to battery electric vehicles will require a lot more copper. So it's a good time to own some copper producers, and Freeport is one of the best. And again, if this year doesn't work out, that would be a good long-term hold, regardless. And my third pick for January and for the rest of the year is a Canadian oil and gas company, Tourmaline Oil Corp. This is more of an inflation hedge, even though inflation appears to be slowing down, as the Fed has done a good job with all the rate hikes in slowing down economic activity, and the market is pricing in maybe one or two more rate hikes, and after that a pause and possibly rate reductions this time the next year or maybe even earlier. A good conventional oil and gas company is good to own, especially when we can buy them at a pretty reasonable valuation, as the world in the last 10-15 years has underinvested in conventional oil and gas. Supplies are restricted in a way because of the underinvestment, and the demand is still growing, and that would be a good area to have some money in. Now, having given all these three picks, I have to recognize that this month, these picks are more risky than my usual picks. So this time next year, the outcome may be a little bit more different than the market than usual. So we could end up doing a lot better or a lot worse. But so that's the nature of investing, and investors get rewarded for taking these risks, and longer term. So, but shorter term, 1 year is still a shorter term in my view. With that in mind, if you had like a second opinion as to whether these stocks fit in your already well-diversified portfolio, or have any other questions, please give us a call. Thank you.